For this module 4, what I want you to do is let's briefly review the items from last week, because they are some of these things that I have here are important to remember for this class and in general for the payroll world. So go ahead and pause this video and let's see how many of the questions below, including the small little payroll register. Go ahead and include that as well. It should take you 10 minutes or so. And then I'm going to go through the answers here in a few seconds. So go ahead and pause, and then we'll see how you did. All right, so from review from last week, which form is filed quarterly for the FICA and federal withholdings? You should have had Form 941. And when are the FICA and federal withholding deposits made? Remember, there are different times, but there's two that are the most common. The first one is monthly, and that's for a business that is small to mid-size, and they have in their look-back period, they've collected less than $50,000 in that last year. And then the other one, besides monthly, is bi-weekly, and those are the ones that are over $50,000. Those are the two most common, monthly and bi-weekly. All right, what percentages are used? This is definitely something you should have memorized for this class and for accounting in general. Social Security is 6.2% and Medicare 1.45%. Social Security is the only one with a cap, and for the year 2019, it is $132,900. Be sure to look and use what I have told you if you're in future years, if you're into 2020 or 2021. Use what I tell you in your notes. Who pays the FICA taxes? FICA taxes are paid by both you as the employee and the employer. Both parties contribute. Typically, so this is onto our part 2 here. What's the earliest age to start collecting Social Security? Remember, that answer is 62. The latest age to receive the most yearly return, so if you want to get the highest possible, you would wait till you're 70. And the normal age for almost everyone now taking this class, there are a few, if you're in your 60s, would be a little different, but almost everyone, the normal age right now is 67. Now note that could change with future law enactments, but at 67 as the current. And then how is a monthly payment amount determined? Remember, they gross your index up by the index rating that you could find on that Social Security website. And then you take your top 35 years, up to the top 35 years, you multiply your wages by whatever index it is for that year, add them all up and divide by the number of years. That's going to tell you how much your normal annual salary was. You divide that by 12. Then that's your, and then you go through, after you have that, then you go through that primary insurance adjustment amount, and you do those calculations. Remember, it's like the first 90% of the first $900 and I think it was $24, and then 32% of the next up to $5,000 and some, and then 15% on over that if it's over that. Review, go back to on that one. That one's probably the hardest one to remember if you want to go back and make sure you know that, because that's something that a lot of people may ask you. All right, hopefully you went ahead and took the suggestion and did this payroll register here. I'm going to go ahead and bring up the answers. You can see how you did. So the person A is the one who's going to hit the Social Security limit. If they had previously, they previously had 128,100. If you add 10,000 to that, that would take them over the cap. So then we got to take what the cap is minus what they've already made, and then instead of 10,000, they only have 4,800 left to be taxed at 6.2%, and that's how I got this amount here. Medicare, the full 10,000, no cap. So we can figure up their net pay just based on these small these two little deductions, not including any other deductions they may have had. And then person B, no caps. They didn't come close to hitting the caps. So we can do the journal at this point. The wage expense is their total wages with no caps, full amount. Taking out the Social Security total, Medicare total, leaves me with how much I still need to pay my employees. And then the employer also has to pay the Social Security and Medicare in addition to what the employee had to pay. So that's an extra $825 expense to them. All right, let's get into our new stuff. All right, so you can see how much the tax code has expanded in 100 years. Incredible amount of tax code. You can read through those. All right, federal taxes, you can see who it's not taken out for. People who are called statutory employees, and I give you a few of them. They're kind of a weird group because they do have FICA taxes taken out, so therefore they don't have to pay the employer's portion of FICA because the employer is supposed to pay it, but they don't have federal taxes taken out. For whatever reason, it would be a lot easier for them if they had federal taxes. It's not that much more work on the employer, so it seems like it would be easiest, but that's why it's called a statutory employee. So there's regular employees, there's statutory who don't have federal but do have FICA, and then there's non-employees, and that includes real estate professionals. Non-employees don't have FICA or federal. They have to pay those on their own as an independent contractor. These guys up here, they don't get out of paying federal income taxes. They have to pay them on their own. They just don't have to pay the FICA part, which is good. Because the FICA part can really hurt you because you have to pay both. And that's what really hurts with real estate. Real estate professionals, even though they may work for RE/MAX, RE/MAX does not take out taxes and doesn't therefore have to pay the taxes. All right, there are several items that you can get for free and not have to pay taxes on them. The first one here is items that are just too small and too negligible for your employer to continually add up on your behalf and then tax you. So if you use the copy machine at work to make some personal copies, technically that is income to you. You're getting something or nothing for free, basically. That you're wasting company resources. Other items like that, use of company cell phone for personal calls. So sometimes a company will pay for your cell phone 100%, but then if you use it for personal calls, you're actually deriving a personal benefit and you should be taxed on that. But the IRS has said that's going to be way too hard to determine and just too much for the employer to have to determine as well. So they call those de minimis fringe benefits, small little items that you don't have to pay tax on for getting a benefit. All right, no additional cost services. This would be if you work for, let's say, Southwest Airlines, and then Southwest, and you want to take a flight. Usually they allow their employees, if there's room, to take a flight for free. Any other type of situation like that, that would be considered a taxable benefit. You would have to include in your income the value of that flight. But as long as it's within your own company and the company isn't going to lose money based on that, like they're not kicking out a paid customer, then it's considered a non-taxable fringe benefit. So that's a nice thing for tax purposes. Qualified employee discounts, you can read through here how much you're allowed to take as an employee discount and it not be considered taxable back to you. Reduced tuition. So this would be somebody who teaches, say, at Ivy Tech or Ball State. An employee of an educational organization can exclude the free or reduced fees for undergraduate work for not only themselves, but their spouse and dependents. So your kids or your spouse could potentially go free to Ivy Tech or Ball State, wherever you work, and you don't have to add that saved tuition back into your income, whereas you otherwise would have. So let me give you an example of something that you would have to add. If your company provides you free membership to a country club, that is a taxable benefit. That is not excluded in any one of these items here. That is something that you would find the value of that country club membership, say it was $1,000, and they would add that into your income and it would be taxed. So you would have to pay an extra tax on that $1,000 free benefit that you got, just like getting $1,000 of income. This is the same thing, but it's specifically excluded in the tax code. So you do not have to pay the value of that benefit, which is big. Same deal goes for other employers who are not educational institutions, but still give their employees money to go back to school. And you can see here, you can take for free up to $5,250 in educational benefits and not have that taxed. All right, employers putting money into your retirement account. Yes, you will have to pay federal taxes on that when you take it out, but the FICA taxes, you never have to pay on that. Medical and health savings plans, the employer pays part of the premium. That's considered a non-taxable benefit, so that's a good thing. The employer puts money into your health savings plan, that is a non-taxable event as well. So you can see some of the items here that are that could be common. And the key basically is anything that's not mentioned in the above or specifically in this link here that has everything, it is considered a taxable benefit if you get it at a lower cost than would normally have gotten it just because of your position. All right, specific payments by your employer that are exempt. So those are some cafeteria plan items. These are known as cafeteria plans. All right, or actually those are not cafeteria. Those are the non-taxable items. And then these are some other ones that are specifically for exempt payments by employer for your benefit. All right, this one is for federal persons only, for federal withholding tax. I thought this one was kind of interesting. If a person dies while they're working, they're still working, and then they die of a heart attack, their last paycheck will not have federal income tax taken out, but they will still have FICA taxes taken out of their last payroll check. I thought that was interesting. Employer provided parking. If you can have free parking and it's not considered a taxable benefit for you. The employer provides group term life insurance premiums as long as those premiums and the policy is a less than $50,000 policy for your behalf, then it's considered free, non-taxable. Anytime an employer puts money into your retirement account, as long as the total amount is less than this dollar figure, and it changes every year. So this dollar figure may be a little bit different in future years. And then one big one here, if you ever get hurt on the job and you get money coming in from workman's comp is not taxed for FICA or federal monies. So if they are paying you $1,000, you're actually going to get $1,000 and you're not going to be taxed on any of it. So it's a little side benefit that you're probably getting less wages, not necessarily, but they're not going to tax you on that. They know you need the money to help pay for any of those medical bills. All right, now we get to the cafeteria plans. So a lot of times an employer will give you an option. You can take cash or you can take these non-taxable fringe benefits. You should almost always take these non-taxable fringe benefits because if you do opt to receive cash, it is taxed, whereas the benefits here are not taxed. So the group term life insurance, that is a big one. If you would happen to die, at least for a year or so, your spouse or your kids would have a little bit of money coming in. Health insurance premiums, if the employer pays on some of your health insurance, that's an extra freebie that you're getting, not being taxed on it. Flexible spending, this is a big one. If you have medical bills that you almost always pay to the hospital, your doctor, or prescriptions, and you don't utilize your flexible spending, you are actually just wasting money. And you're wasting money in that if you put away $1,000 a year, you get 1,000 of that 1,000 to pay medical bills, so 100%. Where if you didn't utilize a flexible spending of that 1,000, you may only actually get 850 because of the Social Security and federal and state and all the other taxes that come out of your paycheck. So you're losing $150 to pay medical items that you could easily have gotten if you just set up a flexible spending plan. Now, there is one big bad item to that, is if you don't use it in a flexible spending account, you lose it. So you always want to be on the low side, but if you almost always have some money being paid towards medical bills and prescriptions, then you should set aside money. Otherwise, you're just losing it. The same goes for dependent daycare. If you know you're going to have dependent daycare, put money aside. You get it dollar for dollar instead of only maybe 85 cents on the dollar or 80 cents due to taxes being taken out. You can read through here. I thought this was interesting. I went to my HR rep several years ago, and I asked them exactly what happens, because you hear a lot of times that it's either a flexible spending, you use it or you lose it. Well, what happens when you lose it? So there are a few items here that explains what happens. And the biggest one is it helps defer the costs of the plan, the flexible spending. So a company like Ivy Tech, they put money into a flexible spending account, but Ivy Tech doesn't manage that account. It's managed by some third-party bank. And the third-party bank isn't going to do it for free. They're going to charge a fee to Ivy Tech to set up this flexible spending. And that fee, then, these monies that you use it or lose it would go to help offset that fee. All right, in addition to a flexible spending account, there's such thing as called a health savings account. If you have this option, you should definitely take it as well. You have one or the other, the flexible spending for medical or the health savings account for medical. You can only use the health savings account if you have a high deductible insurance plan. A lot of people are going to these because the premiums are lower. If you have a high deductible, this is a better option than the flexible spending just because you don't lose your money. If you put it away and you don't use it, it just stays in your account and grows. It doesn't grow a whole lot, the interest, but at least a little, and the big part is you don't lose it. So if in the following year you have a pretty big medical expense, you'll have extra money set aside that maybe you didn't use in the previous years. Then I note here how much you're allowed to put away each year, up to $7,000 if you're on a family plan. Withholdings for retirement accounts, you can see how much you're allowed to put away for retirements. For a 401k, you can put up to $19,000 yourself into a 401k for your own plan. And that's the employee. The employee and the employer together can put away up to $56,000. So the employee putting 19, the employer putting potentially up to the rest. And then notice this number does go up, the 19,000. If you are age 50 or over, you can put away an extra 6,000. It's called a catch-up for those last 10 to 15 years. So that's money taken right out of your check, or you can wait, and if you don't have a 401k option or other similar, you can put away into an IRA through a retirement plan company, say like TIA Credit for the Hartford. And you can set up an individual retirement account, and the numbers have just went up within this last year for 2019. So they'll be at this level for the next 3 or 4 years. They don't change that often. So they're at $6,000 if you're under 50, or they give you that catch-up extra $1,000 for the IRAs. If you're 50 and over, you can put away up to that much. And you can also put away for your spouse as well, even if they don't work, as long as the one spouse makes the total amount that you want to put away. So if both spouses put away $6,000, then the one employee has to make at least 12. You can't put away more than you make. All right, so with an IRA, the deduction that you take is right on the 1040 because this is in an individual retirement plan. It's not usually through your company. So the employer doesn't know you're putting the money aside. So therefore, to still save you on taxes, what happens is you take it off on your 1040 and therefore it lowers your taxable income, and so you pay less federal taxes. Note, it doesn't take off on your FICA taxes, and that's the same for the 401k. Remember, for the 401k, your FICA taxes don't get lowered, but your federal income does get lowered, and we're going to see that as we do some examples here in just a few minutes. So again, if you make $1,000 and you have 100 put away into a 401k, for FICA purposes, like what we did last week, you're going to be taxed on the full 1,000, no break for putting money into a 401k. But you're only taxed $900 for the federal taxes. They get you allowed to take that 100 off. And here you would take that 100 off, but just take it on your 1040. And you'll get a slightly bigger refund because the employer would have taken a little bit too much out because they didn't know that you were putting money into an IRA. All right, not just anybody can participate in an IRA. There are some qualifiers. Change this. To participate in an IRA, either if your company doesn't have a 401k or similar retirement plan option, then you can deduct into an IRA no matter how much you make. So that's if your company does not have a retirement plan option. If the company does have a retirement plan option, then if you make less than $64,000, you're good. You can put money into your IRA. No, you can put it up to the full limit. If you make between, in your single or head of household, 64 to 74, you're going to hit a cap. And we're going to work that cap here in a second. If you make over 74,000, you can't put any money, or you can't, I shouldn't say that, you can't put money into an IRA and deduct it on your 1040. You can put money, what's called a non-deductible IRA. You can still put money in there into a retirement account. You just can't deduct it on your taxes at the end of the year. Notice the amounts here aren't quite doubled for married filing joint. That's considered what would be considered a marriage tax penalty. It's not bad. It's almost double, but not quite. As long as you and your spouse make less than $103,000 AGI, your adjusted gross income, then you can put money into an IRA, no problem. If you're over 123, then you can't put any money. In between, that's what we're going to look at here. To do the phase out, you take whatever the top number is in your category, 123 or 74, minus your AGI. So you're going to be in between these. And then you divide whatever you get by that span, whatever the phase out span is. So for somebody single, it's 10,000. Married filing joint, it's 20. So my example here is, what happens if I'm single and I make 70,000 AGI? How much can I put in and deduct from an IRA? Well, I have to do the phase out. The top phase out is 74,000. Subtract out what my AGI is, 70, and then divide it by the span, $10,000. So the 4 divided by 10 is 40%. So what that's telling us is, instead of putting the whole 6,000 away and being able to deduct all 6, I can only put away 40% of that, which is 2,400. So I could put away up to 6,000 potentially. I just can only deduct 2,400 on the 1040. All right, you can read through, that's fine print. Let's go down to the Roth IRA. The Roth IRA is very similar to a regular IRA, except one huge exception. With a Roth IRA, you don't take any money off of your income taxes now. You're putting it all in and you're paying taxes like you didn't put anything in. The benefit then is when you take it back out, when you're, say, age 70, what the money you take out, first off, isn't taxable because you've already paid the tax, and the earnings that you made. So you could have made a whole bunch. Maybe you doubled your account over 30 years. The interest that you earned is also not taxed. So if you can afford to pay some of the tax now, a Roth IRA may be in your best interest because you pay the tax now, yes, but then when you take it back out, you don't pay tax, or you don't pay tax on the earnings. You get it dollar for dollar. Notice the contributions into a Roth IRA are the same as the regular IRA, and the phase-out limits are slightly higher. Doesn't matter if you have a 401k or a similar option at work. You're going to use the same formula no matter what for any individual. You'd use the same phase-out calculation as we did above, the top number minus where you fall inside that gap, and then divide it by the span. So here it's 15, here it's 10. So what I've done now is just a practice. I want you to take the next 3 or 4 minutes as I go get a drink, clear my throat, and you go through retirement examples 1, 2, and 3. And we'll go through the example. All right, let's go through the retirement example number 1. You got an individual who's age 60. That's important because remember of the catch-up amount. Somebody who's married, does not have a qualified retirement plan, and her AGI is $197,000. How much could she deduct? All right, some of the key words here: does not have a retirement qualified plan. If you don't have a retirement plan at your employer, then you can deduct the full amount, no problem, for an IRA. So an IRA here, the answer would be $7,000 because she gets the catch-up amount. Now for the Roth IRA, the income and the amount that, or the fact that she doesn't have a retirement plan doesn't matter. So we're going to use the phase out. We're going to take the top number for married filing joint, subtract what her AGI is. It's a $6,000 difference divided by the span of 10. So of the full amount, she can take 60%. The full amount was $7,000. She can put away up to $4,200. Now I want to make a note on this. She could not put in both $7,000 and $4,200. When you have an IRA, you can only put in $7,000 for both. The total is $7,000. You can't put away $14,000, for example. 7 into one and 7 in the other. So she could put away $4,200 into her Roth if she felt like it, and then whatever was left into the IRA, she could, as long as that there was no rules for the IRA, and as in this case, she could put away an extra $3,800 into her IRA, just as long as she's under that $7,000 max. All right, Corbin, age 45. That's important. We know that he does not get the catch-up period. Has the option of participating in a qualified plan. That's important for the regular IRA. AGI is $72,000. How much could he contribute to either? All right, let's go back up to our amounts. 72 falls within this span for somebody that does have a 401k option. So we're going to need to do the phase out for the regular IRA. Show you what that looks like. All right, so 74,000 minus the 72, there's not much difference there. There's only 2,000, so only 20%. he can take 20% of the total that he normally would have gotten, $6,000. So he can only put away $1,200 into the regular IRA. However, he could opt to put all of it into a Roth IRA. He does not come close to the cap, $72,000. He's still well under the cap for the Roth IRA. That doesn't even start until 122. So if he wanted to, he could opt to put everything into a Roth IRA and get the full benefit, $6,000. Or he could put $1,200 here and the rest, $4,800 down here in the Roth IRA. Finally, the retirement example. Age 55, so we do get the catch-up option and does have the retirement plan available to her at her work. How much could she put away for each? She's well over the cap for the regular IRA with somebody having a qualified plan. So the answer here is 0. And then the answer for the Roth, though, she is slightly within the cap. So we take the 137 minus 125, where she's at now. Divide it by the span, that's 80%. So 80% of 7,000, because she gets that extra 1,000 catch up. She can put away $5,600 into the Roth. Okay, we are now ready to get into, let's go ahead and I think we'll stop it here, and then we'll have 2 shorter videos. I think those are sometimes more effective. So let's stop here, and we are going to jump in with the biggest part of this lecture here when we get into part 2.